So three benefits: tax credit, depreciation, and income stream. And we're going to draw that out. So the first of those three, the tax credit, the investment tax credit. What is a tax credit? A tax credit is a dollar for dollar reduction in the tax that you owe. You're all familiar with tax credits, even if you maybe aren't thinking about it that way. But when you buy an electric vehicle, you would get a $7,500 tax credit for buying certain electric vehicles in the past. What that meant is if your income yielded a tax bill of $100,000, but you had bought an electric vehicle in that same year, your tax bill would be reduced from $100,000 to $92,500. That was a $7,500 credit, reducing your tax bill. And that's different from a deduction, which we'll talk about in a second. But so the investment tax credit is a credit. And what that means is that if you put $1 into a solar project, you're going to get a percentage of that back as a reduction in your tax bill credit. So how much is that credit? There's two important things to note here. First, I'm going to calculate, or I'm going to talk to you about what that percentage credit is. But then the second question is a percentage of what, right? So the percentage that you're going to get, you can see the math here. The baseline investment tax credit is 30%. Every project that qualifies under the law will get a 30% tax credit as a percentage of the total value of the project. And then in addition, the law allows for various kickers or adders that increase that credit percentage depending on the project qualifying. So you can see here, the project qualifies for an additional 10% credit if it uses between 40 and 55%, basically a majority US-made materials. There's an additional 10 to 20% credit if the project is located in an area with a history of fossil fuel activities. So projects built in certain areas of West Virginia or the Deep South and other places like that, where there's been fossil fuel coal plants and mines and things like this, would get an additional credit. And then similarly, if the project is built in a historically disadvantaged community or on tribal land, there's an additional kicker. Most of our projects, Justin, I see your note there, maybe that we swapped those percentages. They're all in the range of 10% kickers. Most of the projects that you'll find today and the ones that we are offering today are going to be somewhere between 40 and 50% credit, mostly because several of these adders just have not been implemented yet by the IRS in a way that allows projects to qualify. And so most projects that you find today are going to be between 30 and 50%. Ours are between 40 and 50. And so the question then is 40 to 50% of what? And I mentioned that it's a percentage of the project value. There's a really important thing here to talk about when it comes to the format of your project. As Farhan mentioned, there are different types of solar projects. There's flip partnerships, there's sale leasebacks, there are asset purchases. Most of what we do is a flip partnership, and so I'll just use that as the best example here. When you're buying into a flip partnership, let's say you put in $150,000. Most often, the developer or the sponsor of the project is going to match funds, and there's going to be about another $150,000 put into the project. And so the total appraised value of the project will be around $300,000. And this credit, let's say it's 50%, that would be 50% of $300,000, even though you only put in $150,000. We'll talk about the flip partnership structure, but the shorthand to understand for now is that you get to take the full credit on that whole project value. So if you put in $150,000 and the whole project is $300,000, you get to take a 50% credit on $300,000. So if you put in $150,000, you'd be getting a $150,000 credit reduction in your taxes, which means that you're reducing your taxes by the entire value of what you put in, even before we're talking about depreciation and cash flow. And that truly is a very, very large benefit. It's very, very large. The way the math works here, your credit is usually going to be somewhere in the range of 80 to 100% of what you put in that first year. And importantly, this credit does reduce your taxes in the first tax year. Farhan, before I move on to depreciation, anything you want to add there?
Well, Justin mentioned about that correction. Some of the projects, so energy community and low income, there's a possibility that the project falls in the same place and then they qualify for both 20%. So that's 30% base, 10% for domestic content, and 20% for low income. So it can go to 60%. The rest of the 10% is for prevailing wage. But what is
in any way worth understanding that most of the projects these days are 40 and 50, and what we there's documentation to show qualification for these various credits. So that's the credit side, and like I said, your typically recouping most of your purchase size just in that credit in the first year. And then in addition, you get depreciation. So what's depreciation? I'm sure most of you know this, but just to recap or to cover this, depreciation is the decrease in value of a physical asset over time. If you buy a house or you buy a car or you buy solar panels, the IRS assumes that they are losing value over time. There's wear and tear, there's usage, they break, they lose value over time. And you get to deduct from your income a portion of that lost value every year. And so importantly, whereas the investment tax credit is a credit, if you get a $10 credit, your tax bill goes down by $10. Depreciation is a deduction. Just like if you donate money to charity, it reduces your taxable income. It reduces your taxable income, not your tax bill. And so if you get a $100 deduction, that reduces your income by $100. And so your actual tax savings are going to be $100 multiplied by whatever your marginal tax rate is. If I'm paying 40% tax and I get a $100 deduction, then I've saved $40 on my taxes via that deduction. So how do we calculate the depreciation deduction from solar? There's a bunch of math here. Basically, it's the project size. Again, if you put in 150, usually the project is around 300. Your depreciation deduction at the federal level is going to be basically somewhere around 80% of that value. You can see the math here. It's 100% minus the investment tax credit, half of the investment tax credit percentage. That should be half of. And so if you put in 150, the total project is 300, and you get a 40% credit, you're going to get about a $240,000 depreciation deduction spread out over 5 years. How much of that do you get to take in the first year? And that 240,000 could save you as much as, $100-something thousand at the federal level, depending on your tax rate. How much of that do you get to take in the first year, which is a really important question and one that a lot of people ask. That's a moving target, as you can see here. Bonus depreciation dictates the amount that you get to take in the first year. The 2017 tax bill implemented a bonus depreciation that started at 100% and has been reducing every year since. This year, if nothing changes, the bonus depreciation rules dictate that you get to take 40% of your depreciation in the first year. Now, that number might be changed, and we do think that there's a chance that it goes back up to 100% as a result of the negotiations happening in Congress right now. But you're going to get somewhere between 40 and 100% of your depreciation in the first year, which means on a $150,000 purchase, just as an example, happens to be our minimum, on a $150,000 purchase, we're talking about a depreciation deduction of somewhere in the range of $100,000 in the first year, and then another 50 or so spread out over years 2 through 5, as well as some state depreciation that may apply depending on where you live. All in all, adding up that credit, which is 40% of the project size, and that depreciation, which is typically 80% of the project size, in general, we're talking about tax savings, tax benefits of somewhere in the range of 110 to 120% of your purchase size in the first year, as well as another probably between 30 and 60% over years 2 through 5. So if you put in $150,000, on average, we see people getting maybe $170,000, $180,000 in tax savings in the first year, which means, as you can tell, you're getting your principal back. You're getting back the amount you put in plus a nice return. And we'll show you all of this in a case study, but that's the idea. You're getting back more than what you put in when you file your taxes in April after year 1. And then we talked about there's also income stream, which we'll show you in the case study. Anything to add here?
No, I think that's great. For the, we covered about the federal tax credits and federal depreciation. There's also alongside that we have seen state level depreciation, which is an additional, cherry on top. And that numbers, differs depending on the state you live in, because there are different state tax rates, marginal tax rates. If the value of the project, as per your example, where the client is putting 150K as a capital contribution and there's 150K worth of a debt, so it's 300K worth of project value. You're also getting state level depreciation on a 300K project value.
That's right. And in California and other high tax states, that can be significant. Answering a couple of questions here. Ankit asked, what's the minimum investment needed? The minimum for 2025 is $150,000. The maximum is the sky's the limit. We have folks who have put in 8 figures into solar projects. If that's what you need to do, we can make it happen. Manish asks, well, since this is considered a business, can the stay-at-home spouse or whoever claim business expense deductions alongside the benefits we've described? The answer is yes. This is a business that you're running. And if you have legitimate expenses as a result of running the business, absolutely you can deduct them. So home office, if it's dedicated to the solar business, yes. Most importantly, if you travel to the site to view it, which is a big part of the material participation that you'll do, that travel would be deductible. If you go to a conference, which can be part of your material participation, that would be deductible. So yes, the answer is yes, you can.
And I know this is not the part of the question, but one I think thing to call out here is that if you're married filing jointly, your spouse, even your spouse is not a part of your entity, they can still contribute hours towards material participation. As per our accounting partners, it's recommended to one spouse to go above 100 hours, but they can still contribute towards your material participation hours. So this is, an important thing that you can plan out.